Hi there, welcome to Stock Market HQ. Today we're going to take a look at why stocks go up and down. It all starts with a big pile of money which is sitting on the sidelines, and that big pile of money needs to be invested and it will seek out the opportunity which provides the greatest profit potential. Now, the big money managers have teams of financial analysts and market technicians, and they identify a company which they consider to be undervalued. So they'll take their money, which is the hundreds of millions or billions of dollars, and they'll allocate 3 to 5% of their portfolio to buying a stock. That causes the stock price to go up. Sentiment gets more bullish as the stock price goes up, and the pros then notice that the stock price is going up. They don't have teams of analysts, but they can see that the trend is moving upwards. They take their money off the sidelines and they put it into the stock. And as the stock price goes up, market sentiment gets increasingly more bullish. Big money managers and pros go on TV, they start talking up the stock, and then the retail investor notices. They take a look at the stock, they see that it's been going up, so they start to take their money off the sidelines and put it into the stock as well. What happens is as the money comes off the sidelines and into the stock, the pool of available capital has decreased. So in order for the stock price to go higher, there needs to be a new money which comes into the market. As that pile of money has gotten smaller, there's less and less money to go into the stock and to keep it going up. And once the sentiment reaches an extreme, then the process generally starts to reverse. The big money managers and their analysts determine that the stock is now overvalued. They'll issue analyst downgrades and they will start to take their money out of the stock and put it back onto the sidelines. And the pros see now that the trend is going down, so they start to take their money out of the stock and put it into the sidelines. The retail investors now see that the stock price has declined, and they're in a position where they either have to take their money out of the stock and sell it at a loss and put it on the sidelines, or to hold the stock and hope that the stock price goes back up to their break-even level. As money comes out of the market, the sentiment starts to get more and more increasingly bearish until it reaches an extreme in negative sentiment, and then the process once again bottoms once all of the retail sellers or all the potential sellers have sold out of the market and all the money is back on sidelines. And then the process repeats. And that's why stock prices go up and down. Now, when the US, now we want to talk about the effect of interest rates on the pile of money. So the US Federal Reserve controls the amount of money in the system by varying interest rates, either increasing them or decreasing them, as well as through bond purchase programs. What happens when the US Federal Reserve starts to increase interest rates? They are effectively taking money out of the system. So when the big money managers start to buy and take their money out of the pool, and the pros start to buy and take their money out of the pool, and the retail investors take their money off the sidelines and invest, well, the pool of available invested capital is much smaller. Therefore, the price of the stock is not able to go as high as it previously was, and this is how we end up with a bear market in a rising interest rate environment. Thank you very much. I hope that explains a little bit why stocks go up and down. Thank you.